Today, I'm going to be talking about overnight edges, which is actually a presentation I haven't given in a while, but it's something that's near and dear to my heart, and it's a method I've used to trade for years now. And I'm going to kind of go through and talk about the history of how I came to be an overnight trader, and talk about some edges there, and hopefully some people will get some real interesting takeaways from it. Before I get into it, I just got to give you a few minutes here to look at the disclaimer. A lot of the stats and the studies I'll be showing here today are back-tested hypothetical, and there's no guarantee the market's going to do everything it did in the past, right? So there's risks inherent in trading, and people know that. Personally, I like back tests for learning about the market. And once you understand historical tendencies, you're able to take advantage of those tendencies. So that's, but again, nothing works every time. So if you've taken more than one or two trades, you probably had a loser at some point in your trading. So a little preview here of what I plan to discuss in the next 45 minutes. I'm going to discuss a little bit of the history of the overnight market and my history trading it. I'll talk about considerations for using futures or ETFs. You can use both, and I have used both in the past, and I do use both with my trading right now. But there's some fundamental differences and things to consider when you're thinking about an overnight trade in a futures contract versus ETFs. I want to talk about some overnight research and tendencies, and this should be a real interesting part of the webinar for a lot of people. I'm going to get into some seasonal considerations, and that will, I've got some seasonal studies to share that I think people will find very interesting as well. I'm talking about my beliefs as far as trading overnight edges and the beliefs that I founded the website on. I'm going to talk about some of the tools that we have that people can benefit from, and then reasons to consider an overnight trading strategy if you don't already have one. And I guess I'll talk about some reasons to not consider it as well. Not everything's perfect, but this is one of my favorite approaches. So let's get into it. So I don't want to spend too much time on my bio. I got a lot of other stuff to cover today, and we already talked about it a little bit. But I've been trading the overnight since first quarter of 2005. I first found some edges and began looking to take advantage of them towards the end of 2004. I traded it privately for several years. In 2007, I advised on an overnight strategy for a startup hedge fund. The hedge fund didn't make it, but the overnight strategies did well, and that got me encouraged to expand on them. And I incorporated market internals and seasonality in 2010. I made some of my approaches a little bit more adaptive at that point. Up until that point, I was trading basically on price action. And I'll show some examples of what I mean by price action versus seasonality and so forth. In 2012, I launched overnight edges. We already discussed this a little bit. And that joined with Master the Gap in 2014 and became InvestorQuant. And in 2016, I released 3 automated trading systems based on the overnight research that I've had. So those have been around for a couple of years now. And they're largely based on stuff that we've been doing since 2012. So let me, excuse me. Sorry about that. The dog's going crazy. So someone just came to the door of the office over there. It's getting taken care of. All right. So the chart here is just an old daily chart of ES.D, which is the continuous S&P E-mini contract that looks at prices between 9:30 and 4:15 settlement. So it's not looking at the overnight in these bars. I could just as easily use the chart of SPY or really any New York Stock Exchange security. The part of the chart that I'm interested in and planning to discuss today is basically the uncharted portions. So I'm going to quantitatively look at what happens between the afternoon close and the opening the next morning. All the dotted lines on that chart show the overnight movement, which, as you can see, is often substantial. So now that you know what I mean by overnight movement, let's discuss day versus night activity. All right, first let's talk a little bit about the impact of the overnight session on stock prices. The stock exchange has regular trading hours, 5 days a week, 6.5 hours a day. That means during the 5-day work week, the market's closed for regular trading about 2/3 of the time. So if you add in weekends, the market's really only open less than 20% of the time. So it's not surprising that most market moving events occur when the market's closed. Many of these events are planned events, such as earnings releases, which typically happen before the open or after the close of the regular trading. Many economic reports, like the employment report, which came out this morning, also happen outside of market hours. And that often causes the market to move and gap in itself. And it did today. And of course, happenings in Europe, Asia, other parts of the world will often happen when New York Stock Exchange is closed. Or we could have, like we had last night, Trump came out with some talk about tariffs. So anything that's said outside of market hours that could impact the market is going to be reflected in the next morning's open price. So both institutions and professional day traders are keenly aware of the fact that the markets can go either direction overnight, and they do an awful lot to avoid or offset perceived overnight risk. That's a term you hear a lot, right? Oh, the overnight risk. But what many of them don't realize is that the substantial amount of premium that they're paying to offset these perceived risks. Overnight traders basically look to make money by collecting this premium and absorbing some of this risk. Now, by using historical probabilities, overnight traders can better evaluate the risk reward that's available. So this allows us to only take the risk under certain circumstances which have historically been shown favorable to do so. We don't want to take home positions every night, just the nights that show the highest probabilities. And historical probabilities are also useful in determining where risk reward is skewed so greatly against overnight long positions that a short position is justified. I don't trade shorts as much overnight, and when I show you some of the charts, you'll understand why. But I do trade it, and I've made money on the short side as well. So let's take a look at some historical charts, and you'll better understand some of what I'm talking about here. Actually, first let's look at this chart, which is the growth that we've seen in overnight trading over the years. This is ES monthly overnight volume, dollar volume. Okay, going back 20 years. What was interesting to me is not only the fact that it's increased hundreds of times over the last 13, 14, 15 years, but we actually hit an all-time high in February as far as the amount of dollar volume that was moving in the overnight period. So all the increased volume means increased liquidity, right? And increased liquidity is generally viewed as a positive for people that are trading in the overnight, right? So when I get in and out in the middle of the night, you can, especially these days as opposed to 15 years ago. You know, when I first started trading the overnight, I was doing it mostly with ETFs, so I didn't care so much about overnight liquidity. And really, that kind of takes me to my next slide, that overnight liquidity generally is a luxury. Most of the trades I take don't require it in order to successfully make money, because the edges are designed to take advantage of this time, but taking advantage of these edges doesn't mean we're trading during the night. Executions typically take place at the two most liquid times a day, the open and the close, right? So people who trade ES or SPY will generally be trading the most liquid instruments in the world, or some of them, right, outside of bonds and stuff, at the most liquid times of day. You're getting in right near the close, you're getting out right near the open. And during these times, slippage is minimal, so it's not something you really is a big deal. We'll have positive slippage some days, negative slippage some days. Some days it's very little slippage, but it isn't anything that is a big detriment to the strategies. All right, these next two charts are the ones that first got me excited about overnight trading back in 2004. I mentioned that was when I first really started doing the research. So this is a chart of SPY, and it's just if you held one share of SPY every night since its inception in 1993 into last month. All right, so what we see here is it has gained over this time $245 and change. And there's only been 4 years out of that entire 25-year period where it's lost money. That was 2001, 2002, 2008, the big bear market years. And then 2016 was an odd year, and the overnight did suffer that year. But as you can see, it bounced back nicely in 2017. These results also don't include another $58 in dividends that are paid to overnight shareholders. So really, there's been over $300 in gains in SPY over this time. Now, SPY's trading today at 262 and change. So you've had $300 in gains. It started around $45, I think. And it's at 262 now. Obviously, hasn't done much during the day. It's lost a bit during the day, actually. And this is so this is an interesting chart to me as well. What we see is that there's been over this period net loss of $21. 2018, when I ran this last month, it's currently negative. I think still is. And it would mark the 14th year out of 26. So more than half the time, SPY has been a net loser during the day. What's also interesting to me about this chart is that it speaks to how the market acts during bull versus bear markets. So what we see is the first couple of bull markets here. This is the bull market of the 90s. This is the bull market from 2003 to 2008, early 2008. They were both pretty even during the day. The money was made overnight in those bull markets. Bear markets, you can see that's where there were some big moves lower. Now, we didn't have big moves lower during the overnight in the bear market. There were some mild ones, right? They weren't huge. And this makes sense because bear markets happen because there is selling. People are getting out of the markets. Institutions need to liquidate positions. They can't liquidate them at night. They got to liquidate them when the market's open. So when the market's open, that's when the selling's happening. And that's why you're seeing most of the losses occur during the day. Now, just as interesting to me is the fact that the bull market since 2009 is the first one going back into the early 90s that actually made money during the day. It's done quite well. So is that because of a QE infusion? Is it just something else where market dynamics changed? I don't know. But it is interesting to me that what used to be flat bull markets, right? Flat during day bull markets, is now making money during the day and at night. So not all the gains are coming at night anymore, but we're still getting good gains at night. There's still plenty of overnight opportunity. All right, let's talk a little bit about futures versus ETFs. I've traded both with overnight strategies. I focus more on futures these days, but with certain accounts, I still use ETFs. So here are some differences that traders may want to keep in mind between these two security types. Futures are open 23 hours a day during the week. There's a 15-minute closure between 4:15 and 4:30 at the end of each trading session. And there's also a closure, and I'm talking Eastern time, from 5:15 to 6 p.m. Eastern time. ETFs are only available to trade 12 hours a day for the most part, with after-hours trading ends at 8 p.m. and the pre-market starts at 8 a.m. Now, there are some brokers, I think TD Ameritrade now allows 24-hour trading of certain ETFs like SPY and QQQ. So you can trade some of them 24 hours, similar to the futures, but you're not able to use stops during the after hours. You can use stops with futures, so that is something to keep in mind. After closing at 6 o'clock on Friday, futures have a Sunday night session as well, and that begins at 6 p.m. Eastern Sunday night, and that runs through the night. ETFs will close on Friday and open on Monday morning, for the most part. I'm not sure what TD does right now. So they're closed for quite a bit longer. Futures traders have the ability to use stops and targets on their positions, except during that weekend session, right? So you could close on Friday and gap up or down on Sunday. But for the most part, if you're trading futures and you're sleeping and something happens, you can have your position automatically exited. ETF traders don't have that advantage. They can use targets if it's within that time frame, but they can't use stops. And lastly, to consider is that futures are highly leveraged. Right? ETF traders might use leverage, or they could trade a 2x or a 3x ETF, but leverage isn't necessarily inherent within ETFs. So it's a two-edged sword, and traders just need to be aware of the risks when they're doing any kind of trading with leverage. Right? You can make a lot more, you can lose a lot more. So you got to be careful with it. All right, let's get to the good stuff. Let's talk about some simple overnight tendencies. All right, so this chart here is similar to the historical SPY chart I showed earlier, but instead it looks at ES action over the years, not looking at SPY. And it's simply a profit curve that looks at returns if someone were to buy the ES settlement and exit at the open the next day. No commissions, no stops, or targets are used here. It's just holding through the overnight session. And the reason I don't include anyone who conducts studies like this is we're simply looking to learn about market behavior. Studies like this aren't systems, but they can provide useful information and ideas to build systems from. So this chart looks at overnight returns if you bought ES each day in which it closed up on the day. So it closes above yesterday's close. As you can see, despite the tendency I showed earlier for the market to rise over the years, it actually fared pretty poorly following up days, which is interesting. And up to that 2009, right, it was negative. Since then, when the market's done real well, it's still All right, now let's look at the opposite. So this chart shows the result of buying every down close of the market. As you can see, this has worked pretty well over the years. The difficult years were 2001, 2002, 2008. The ones that we already kind of identified were tough years. But other than that, gains were pretty steady, 2016 also. So the bottom line with these two tests is that the night will often see a reversion of what occurred during the day. That's interesting, right? If we're down on the day, we're likely to pop up at night. If we're up during the day, we're likely to see it move down during the night. Just as interesting is that this reversion phenomenon has also been in play versus the previous night, not just versus the previous day. To see what I mean by that, let's check out the next chart. So in this case, we're looking at returns of buying any night in which the market has gapped up the previous night. Doesn't matter what it's doing during the day today. If we gap up this morning, what happens if we buy tonight, right? So ES opens above yesterday's close, what we see here is the negative tendency is actually stronger than the tendency we saw when buying positive closes versus the previous day close. All right, let's see what happens after you get a gap down the day before. Pretty amazing. This is the steadiest and probably the most impressive curve yet. The ES gap down today, which actually it did this morning, right? There appears to be a pretty good chance that it gaps up tomorrow. All right, so let's look at what happens when we combine these concepts. This chart shows what I refer to as a double up day. That's a day where ES gapped up to start the day, and it closed up versus yesterday's settlement price. Right? Doesn't matter where it closes versus the open. It's we open above yesterday's close and we close above yesterday's close. And for a long time, such days have been followed by a downside overnight tendency. It's flattened out a bit lately. And I'll continue to keep an eye on that. But what this means is you're kind of you're going against it if you're trying to buy an overnight where you gapped up this morning and you closed up and you had a double up day. So it's a warning sign against trying to get long that night. All right. What about double down days? Double down day, meaning we open below yesterday's close and we close below yesterday's close. Buy the close today, sell tomorrow's open. This is the best curve I've shown you yet, right? This is pretty sweet. Days when the market has gapped down and closed down, there's been a bullish overnight tendency on a pretty consistent basis. I never take short trades in this when this occurs. If I'm seeing odds or other studies that suggest, hey, we might have a downside edge, but we've got a double down day, I don't take those short. This has invalidated everything else pretty much, and turned what would otherwise be a good short strategy into neutral. So these are some tendencies that are fascinating and that we can work into setting our market bias. All right, let's move on to talk about some short-term positioning considerations, not just general up and down tendencies, but where's the market making these moves from? Both short and long term can be helpful when thinking about things. So here we're saying, all right, yesterday was a 5-day closing low. ES gaps up this morning, and then it closes up at least 1% on the day. So you're starting at a low, and then you get a gap up and a push higher. Now, the double up day has often had a negative bias, right? But in this case, since we're coming off of a 5-day low, we're not seeing that negative bias. That's worth noting. When you're extended to the downside and you get a strong move up, you might have bears trapped. Those bears are not going to get let off the hook overnight. So you don't get that downside reversion that you might otherwise get. And might you otherwise get it? Let's look at the same pattern coming from a 5-day high. Here we see, all right, after closing a 5-day high yesterday, we had a gap up this morning, and we close up at least 1% on the day. Now the downside tendencies are pretty strong. In this case, you got over exuberant bulls that look to ride the momentum overnight, and they're getting hit with reversion and are largely disappointed the next morning. Let's look at intermediate term considerations, not just short-term ones. Here we're looking at, all right, what happens if we close at a 20-day high when we're above the 200-day moving average? And if you remember, the tough years were the ones where you had when you were in bear markets. The bull market years were pretty good for the overnight. But when you're at a 20-day high, you're already overextended. It hasn't been all that good, right? And for a long time, this was a strong downside tendency. It hasn't been down. It hasn't been downward the last few years, but it hasn't been anything that gets me excited about trading. You want something excited that I get excited about trading with? Let's flip it. Instead of looking at a 20-day high above the 200, let's look at a 20-day low above the 200-day moving average. That's a curve I can get excited about, right? That's a strong upside tendency that's happened for a long time. So these are some examples of how price action, whether it be one day, double up and double down days, whether it be short-term price action, or whether it can be intermediate-term price action, can impact and affect overnight odds. But price action isn't the only thing that affects overnight odds. Another thing to look at is that overnight edge is an invest point here is seasonality. So let me show you some seasonality studies. This one just looks at Fed days. Fed days happen 8 times a year. It's the day that the Fed comes out and makes their policy announcements. They raise interest rates, lower interest rates, whatever they're going to do. All right, so if you buy the close the day before Fed day, what we found is a lot of times you get a nice gap up on the Fed day. Okay, but this isn't a tendency that is unknown. This is actually something that has been known by people for a while. So what happens is, a lot of times you get these seasonal tendencies, and they can be front run. So if we put a front run check in front of this, we can really see something. Check this out. Same thing, tomorrow's a Fed day, but now ES is closing in the top half of its intraday range. In other words, it had a pretty good afternoon. That could possibly be people pushing the price up during the afternoon, trying to front run that overnight edge going into the Fed day. That happens. That curve that looks pretty good before looks like garbage now. It's just sideways chop. It's nothing that, no one's buying this system, right? All right. What if it's not getting a front run? What if we're going into a Fed day and people are worried about what the Fed's going to say, and it's selling off going into the Fed day? Boom. Pretty powerful looking, huh? That's a nice, steady move higher over a 18-year period. So those are the kind of edges we like to look for. We found that the overnight market has offered some very consistent edges over the years. And I'm happy to answer questions on any of those. Any of those charts, and I'll be happy to go back to them. I got some more things to get through, but I have also left time for questions at the end. So I got a few more minutes, and we'll have a good 5-10 minutes for questions as well. But we've seen these kinds of consistent edges over the years, and they can be enhanced by looking at a combination of price action, seasonality, and we also look at internals, which is such as breadth numbers. Pattern studies can also be quite useful. So when I talk about pattern studies, I'm talking about like the 20-day low above the 200-day moving average, things like that. To take advantage of these types of edges, we've developed some tools at InvestQuant, and I'll go through and just show them briefly, but this is kind of how I go about my decision making. When I go into each day, I'm thinking, all right, what are the odds that we're going to gap up tomorrow morning? What are the odds we're going to gap down tomorrow morning? And I'm looking for those odds to be strong in one direction or another. So this is what we call our index roll-up page. And it breaks it down by we have price action, internals, and seasonality that we're looking at. We look at the percent of the time that ES, YM, all eight, we call these our grade 8 securities, but it's really the four major indices, their futures, and their ETFs, right? So the corresponding ETFs. So we're looking at the percent of time when price action has been similar to what it is now that we saw a gap up, when internals have been similar, when seasonality has been similar. What has there been a gap up or a gap down? Profit factor, for those of you that aren't system traders, all that looks at is gross gains divided by gross losses. So system traders use it to compare systems. If you've got two systems that both made $10,000 over the course of the last year, and maybe it was even on the same number of trades, system one did it by having $20,000 in gross gains and only $10,000 in gross losses. 20 divided by 10 gives you a profit factor of 2. That's generally viewed as more favorable than system B, which had 100,000 in gains and 90,000 in losses. Because now you got to endure a lot more losses to make the same $10,000. Okay. So near the end of the day, this starts updating at 3:30 Eastern, and for the next 45 minutes, it updates every minute, showing how the odds are changing as the market's moving with its internals, with price action. Internals stop changing after 4 o'clock. Price action keeps changing up until 4:15. At 4:15 is when I'm making my decision on what to do. And this is the primary tool I look at. This is the first thing I look at. So I want to know, what are the odds? And I trade ES and NQ more than anything else. If something's showing up at 55% and a 1.3, it's getting highlighted in green. And if it shows up as weak odds, it'll get highlighted in orange. All right, so we saw some green on the screen that particular day. We also have what we call the Edge Finder. The Edge Finder looks for pattern studies. So if you've got a few hundred studies that are saved, and if any of them trigger, it'll come up in our Edge Finder. This is just an example. So there's been 95 times where tomorrow is a Fed day and ES closes below a 20-day high. 2/3 of the time saw ES gap up the next day. Profit factor for long entries would have been 2.16. All right. So some of these are seasonal, some of them are pattern type studies. There is a trade discussion room. I'm in there about 3 days a week, and we discuss the overnight potential, including the odds, any special studies, any other considerations. For instance, yesterday I was talking about the fact that we had the employment report this morning. I generally am much more cautious trading ahead of an employment report. So I like to see everything lining up really well if I'm going to take a trade ahead of an employment report, because it's a wild card. The reaction to it is tough to anticipate. So I might take a trade if everything's lining up nicely, but I'm much more stringent about those. So that was the point of discussion yesterday, and we got into that quite a bit. And we also have blueprints. I'll talk about blueprints a little bit. Actually, I think the next slide's on blueprints, yeah. So blueprints, there's 3 defined rule sets for trading in the overnight session. There are basically 3 systems, right? Rob's shoulder, which mimics the decision-making criteria that I've had in place since 2012, that I've made the market calls every night and managed an overnight account for years, trading based on what I see going into the night. Quirky shoulder is the NQ version of Rob's shoulder. So these are automated. This takes all the decision-making criteria I used and automated it. In 2016, we released these. Golden Slumber uses some of the more popular price action studies. It does look at the odds a little bit. It's less stringent there. Anyway, all these were officially released in 2016. 2016, and there's automated alerts available for all of them as well. So the website you can see alerts. There is blueprint performance shown on the site. So this marks the date that the blueprints were released in 2016. Really, Rob's shoulder, you can go back to like August 2012 to get, that's when I started the Overnight Edges site, right? So that's more accurate if you can look back that far. The others, this is the 2016 date right there. You can see how they've done over time. Golden Slumber. Okay, so that's all available on the site with detailed stats and data. We do have strategy alerts. So at particular times of day, you'll get alerts as we're approaching the close. You can see those on the website. Some people like to just check out that page rather than going to the trade room. Some people prefer to go into the trade room, see what other people are doing, see what I'm thinking, and all that. All right, let's talk a little bit about some reasons to consider overnight trading if you're thinking about it. I mean, what would make you want to take the leap from viewing overnight tendencies as, you know, simply interesting to actually using them to trade, I guess. There's a lot of reasons, but here's just a few. As I showed, there's substantial edges that are available only in the overnight session, and with interest rates still so low, your money's not really working for you too well overnight. And some brokers still aren't paying anything on overnight cash balances. Another nice aspect of overnight trading is it doesn't require you to sit in front of the screen while you're in a trade. In fact, for ETF traders, it's not even possible to sit in front of the screen. Personally, that's something I hate doing. I hate screen watching trades. So I've always found this very appealing. I've traded both ETFs and futures using overnight strategies. Futures, of course, allow you to adjust your exit or exit your position during the overnight session. For me, that's done using stops and targets. So I don't sit and watch the position or move those stops and targets during the night normally. I will just kind of set them after I enter the trade and let it go. And then if I'm taken out of the trade at night, fine. If not, I'm getting out at 9:30 in the morning. Of course, perhaps the greatest advantage that overnight trading allows is that traders are able to diversify their strategies, and it provides opportunity to profit that otherwise wouldn't be available. And for me, I have found my overnight trading to be uncorrelated with any other strategies that I've implemented. This is how you think about it when talking about compounding. You know, if you're a day trader, if you implement an overnight strategy, it's not additive to the gains of the portfolio, but really it compounds it. You know, if you're trading for 1 year and you've got the day trading strategies going during the day and the night trading strategies at night, it's really like getting 2 years out of it. So the money is able to compound. A trader that makes 32% in a year day trading could double that with a 25% gain during the night. Looks like a question came in. I'm having trouble seeing these. What is the best hours is being asked. I've tested the best times to enter into these overnight positions, and really it has been right near the 4:15 close most of the time. I've looked at, what if we go in a little early? I've looked at, what if you go in late? Best entry time that I found is right near the futures close. Okay. Before I run out of time here, we do have a special offer. The coupon code you see here, OE500 promo, is designed to take $500 off for the next, I was going to say a week. It's up until Wednesday that it's good. That it's good for. So if you sign up for an annual subscription, which is typically $24.99, you can get that for $19.99. Or monthly subscriptions are $249. It'll take the entire thing off the first month, right? So you're not getting $500 off there, you're getting $249 off. It's $500 off your first payment. So basically saying first month is free. You can cancel it within 30 days and you'll never pay anything. Otherwise, you can renew at $249 a month, or then go sign up for annual for the $2,500. And even if you sign up for an annual, you do have a 30-day money-back guarantee on everything in InvestQuant. So if you signed up for an annual and you said, you know what, I don't think the overnight's for me, and it's not for everybody. It is for me. I love it as far as trading it. But if you decide I don't like doing it, I don't like worrying about my positions at night, whatever it is, cancel in 30 days, get your money back. That's all it is. So whether it's an annual or monthly, really, we got a 30-day free subscription here to try it out. And I'd encourage anyone that's interested, anyone that takes that enjoys using statistical rigor to make trade decisions, to give it a try. Looks like I got about a minute left here if anyone has any additional questions. Like I said, for me, the overnight has been a solid strategy. Doesn't take a lot of time. I make my decision near the end of the day. I know what I'm getting out, and I like that. And meaning the next morning I'm out. And it's uncorrelated. Those are the big advantages that I've found over the years. All right, I guess that's it for me. Thank you. Thank you for everyone for attending and listening. You can contact me at rob@investaquant.com if you have any questions.